Talk to the talk to the Saturday morning, my Seru is waking. Traffic is crawling, the taxis are shaking. Coffee is steaming, I'm scrolling my phone, looking for headlines that feel like home. You keep me updated on all that matters, from business moves to the campus chatter. Lesotho'S stories in every line. I ride with you. The Saturday Times, you keep my mind online, bringing that truth to the people every time, from Facebook feed to the YouTube shine. I stay plugged into the Saturday Times.
The Monetary Policy Committee of the Central Bank of Lesotho met today to assess global and domestic economic developments and to determine the appropriate monetary policy stance consistent with maintaining price stability, safeguarding external reserves, and supporting sustainable economic growth. The committee noted that the global economic environment remains highly uncertain. It is characterized by elevated geopolitical tensions, uneven growth prospects, and evolving financial conditions. Since the previous MPC meeting that we held here, the greatest new risk has been the conflict, as you are all aware, in the Middle East, that has triggered the closure of the Strait of Hormuz. This has caused shipping traffic through the strait to fall significantly, resulting in major global supply shock. As a result, international crude oil prices rose nearly 50% since December 2025. These developments mark a shift in the global outlook from this inflationary trajectory to rising taxation risk. Amid the heightened global uncertainty, major central banks, such as the US Federal Reserve Bank and the European Central Bank, therefore, adopted cautious stances by holding monetary policy rates unchanged in March 2026. The IMF noted that an increase in oil prices, if persistent, will result in an upsurge in global headline inflation and a consequent fall in global output. This is sad news for the world. Against this backdrop, the IMF projects that global growth will be around 3.3% in 2026, though a significant downside risk may emanate from the conflict. Global markets faced heightened stress marked by rising bond yields, elevated volatility and a broad weakening of emerging market currencies, including the South African rand against the US dollar. The committee noted that in the common monetary area, the South African Reserve Bank growth projections for South African economy remained broadly unchanged at around 2% in the near term. Nonetheless, the ongoing war presents downside risk to this outlook. The South African headline and core inflation rates were 3% in February 2026. The new inflation target was hit. And mainly this was supported by strong rand against the dollar at the time, and of course falling energy prices at the time, which the situation is different today. However, higher energy prices because of ongoing war are likely to raise inflation in the near term. Consequently, the SARB maintained its repo rate at 6.75% per annum, which, as you look at it, is a cautious stance against the potential pressures on prices and rising inflation, and against this global uncertainty. The committee considered also factors on the domestic economy and how economic activity has fared amidst this uncertainty. On the domestic front, Lesotho's external position remains strong. The net international reserves stood at 1.125 million US dollars as of the 18th of March 2026, which is 30.9% above the minimum threshold. And this, the committee noted, it will support around 4.3 months of import cover, of imports. The fiscal policy, which often exerts pressure on reserves and the external sector, has remained contained, contributing positively to the preservation of the reserve buffers under Lesotho's fixed exchange rate regime. The committee noted that international reserves are expected to remain broadly stable, with the near-term net international reserve outlook pointing towards a reserve above the target throughout September 2026. However, risks remain, including the rand depreciation and the US tariffs that continue to threaten the textile exports and the textile industry in general. The committee noted that domestic headline inflation moderated to 2.7% in February 2026. This moderation was from 3.4% that was noted in January, reflecting broad-based easing in food and transport prices. Food prices eased on improved tender harvest, while transport inflation declined in line with lower international crude oil prices prior to the conflict. The medium-term inflation outlook, however, has been revised upwards given the risks that we talked about from the oil prices, from the oil price shock, potential El Nino conditions in 2027, and exchange rate volatility. The composite indicator of economic activity showed a modest growth of 1.5% in January 2026, following a 4.3% expansion in 2025. This mainly reflected robust domestic demand and improved financial services performance. The gains, which were partially offset by contractions in the construction sector and transport subsectors. Crop will remain subdued. Private sector credit expanded in January 2026 with annual growth of around 12.8%. However, credit growth is projected to decelerate to 4.6% by 2028, reflecting lower investment demand as Lesotho Highlands Water Project Phase 2 construction winds down. Risks to growth in this country may emanate from external spillovers and persistent structural constraints that have faced its economy for more than decades now. After careful considering the balance between maintaining external stability while supporting domestic economic activity, the MPC noted the following: that strong reserve buffers with net international reserves 30.9% above the minimum threshold. 2, it noted that external conditions, while increasingly uncertain, do not currently necessitate a defensive policy response. 3, it noted that inflation remains broadly contained. However, there are risks of higher than expected inflation arising from anticipated increases in fuel energy prices, which will rise fuel and transport costs and may fit into broader price pressures in the near term. That weak domestic economic conditions, with the economy operating below potential, which requires caution against overly restrictive policy steps. In light of all this, the policy decided to maintain the CBL policy rate at 6.5% per annum. It is at this level that the committee noted that it is appropriate to maintain a modest negative interest rate differential of 0 and 50 basis points relative to SARB rate, which is currently at 6.75%. This is done to sustain the exchange rate peg and consequently to support domestic economic activity. This committee will continue to closely monitor global developments, particularly the evolution of conflict in the Middle East and its implication for energy prices, its implications for inflation inflation and its implications for capital flows, alongside domestic inflation dynamics, and of course, the evolution of the external position. Further policy decisions will remain data dependent and will be guided by the need to safeguard the reserves, and macroeconomic stability as much as possible. Colleagues, ladies and gentlemen, this brings us to the end of the statement today.